Now I'd like to introduce you to John Freiberger. John is the founder and managing partner of Partners Wealth Management, and he is an experienced certified financial planner. John's passion is helping his clients grow long-term sustainable wealth. He works with the rest of the Partners Wealth Management team and the network of experts, just like Dan here, our presenter, to partner with individual business owners, high net worth individuals and corporations, helping them find and gain financial independence and achieve all their goals. So I'm going to pass this over to John to introduce our speaker today.
Thank you, Cheryl. And good morning, everyone. So I'm excited and honored to introduce Dan Segal. He's a friend and a valued advisor to Partners Wealth Management and to our clients through the years. And he has a fancy title at Business Transition Advisors, but we call him Dan, the ESOP man. Now, he's been in the business for a decent amount of time. It doesn't look like it relative to me. And so his experience spans many different disciplines, but he's really focused on the ESOP world. And I mean all things ESOP. So from the education on the front end, which you'll see today, to the design, the implementation, and then the ongoing maintenance. And then in some cases, the strategic exit from the ESOP program. So we got a lot of territory to cover today, a lot of information we want to share with you and conversation. So Dan, you ready to take it away and have some fun?
I'm ready to roll. Thank you for the nice introduction. I'm ready to get rid of this picture of me.
Well, before you jump in, I took a look at our attendees and to give a little background here. So we have clients who have ESOPs. We have clients who are thinking about ESOPs. We have clients who are attending today who are just curious, what the heck is an ESOP? And we've been at this for 30 years now. So Partners Wealth Management in many ways has become an advisor to other professional advisors of all different sorts. And so we have several of them here today who are here to pick up some wisdom.
That's awesome. And I'm actually honored that you'd have me, because I know the quality people you surround yourself with are just the best in the business. And I'm just humbled that you think of me that way to allow me to talk to your wonderful people. So thank you. I appreciate that a lot. Yeah. All right, we'll talk about some ESOPs here. Now, it's an easy tendency to start getting into all kinds of tax code and the history of ESOPs since 1974 and every tax law change, but we're not going to do that today. We're going to talk about kind of the practical side of things. What is an ESOP? How does it work? What are the tax advantages? Who controls the company? What value do I get? And what's my family's role and things of that sort, things that really matter to people, because no sense getting into all the minute details when we don't know what the heck we're talking about. So this was designed to give you an overview of how an ESOP works and all those things I just mentioned, so you can kind of get a handle on it. And then if it maybe someday, if you're not an ESOP company and you want to consider it, might be something you have in the back of your mind that you might want to consider. If not, you had a little education and that doesn't hurt anybody, right? So let's start here. I think Vince Lombardi said, gentlemen, this is a football. Well, ladies and gentlemen, ESOP stands for Employee Stock Ownership Plan. People confuse it with stock options. You know, I worked IBM and I got, 3 million of stock options. No, that's something completely different. ESOP actually means something to the IRS and the Department of Labor. It's an actual true blue retirement plan under the same code sections of 401ks, pension plans, things of those sort, profit sharing plans. It's a true blue retirement plan. We have to follow some of the same rules that you'd find in all those other plans: discrimination testing, contribution limits. We have to treat people fairly. So we have to follow those rules. But, when we do follow those rules, we get some really nice tax advantages and other advantages. And so if we do what we're supposed to do, there's some very nice results, and we'll go through some of the key ones. Now, just the power of employee ownership for the company and employees. ESOP companies are just generally 25% more likely to stay in business than a peer company without an ESOP. The pre-COVID recession, 2008 and so, and as well as the preliminary studies I've seen about COVID, employee owners were 4 times less likely to be laid off. They tend to be stronger. The tax advantages and the goodwill and the employees that have an ownership stake it just creates stronger companies. And I'm not saying you don't have a strong company in any way. I'm just saying statistically, ESOPs kind of accelerate engagement and productivity, and it just does statistically. And they get employees get rewarded for that. Employees at ESOP companies compared to a similar employee at a non-ESOP company, they average 2.5 times the retirement plan balance than their peer at a non-ESOP company. That's pretty dramatic. 2.5 times average greater retirement accounts so they can enjoy retirement comfortably, 2.5 times than the similar person at a non-ESOP company, and they generally receive higher wages. I don't know why the research came up with 5 to 12%. I don't know where that number came from, but that's the number that's published. So it's a nice win for the employees, and as you'll see, it's a very nice win for the sellers and the company itself as well. Now, you're welcome to have this presentation after we're done. You're welcome to have it. And I'm not going to read these quotes, but the point is ESOP share incredible bipartisan support. I bet you cannot name another subject where Bernie Sanders and Ronald Reagan both are endorsing the exact same thing. People kind of laugh at that, but it's true. I mean, they come at it from different angles. Bernie loves employees getting independent, loves employees getting a share where they work. They work hard, they deserve to be rewarded that way. Kind of the other side of the aisle says, hey, we love employees having independent wealth. Those are less people in the government safety net. And companies that have tax breaks hire more people, they grow, they expand their facilities, and they do good things. So in ESOP solves both sides' concerns. They come at it from different ways, but it proves to be very successful. Now, as we're getting started, to kind of set the stage here, here's what a general ESOP candidate profile is, where kind of I don't want to say the minimum, because that's not true, but things really start working when we have a company worth about $10 million of value. And, we could just say, 2 million of net income or adjusted EBITDA, if that's more your style. EBITDA, we could add back some owner's salary. We could add back maybe some of those things that are in the financials that maybe shouldn't be, we can add back. When we get to an adjusted EBITDA of about $2 million, that equates generally on average to about a $10 million company. Now, we have done ESOPs at $5 million value companies. If the cash flow works, we need to watch that. We also need payroll of about 1 million, 25 or more employees. And it really doesn't matter about family or non-family owned businesses. There's kind of a misnomer about the family. They can't do an ESOP, and it's actually very popular. Now, here's what I hear, and tell me if I'm wrong. John, please feel free. You work with a lot of business owners, so tell me if these aren't true. If you have anything you want to add, please jump in. People ask about or any method. Can I get a fair market value and leave my company financially sound? That's important. Owners say, look, I built this thing from the ground up. I don't want to just strip everything out and let the company flounder and maybe go bankrupt the year after I leave it. There's a legacy there. And can we find a way to leave the company sound and me still get a fair value? Will my management or my children be able to or willing to obtain financing to buy me out? Can they come up with the money? And I'll be, what often happens is, and John, I know you found this to be true. A lot of times senior management want to run the business. They want to get the business. I'll go get financing. I'll do whatever it takes. But then that management goes home and talks to their spouse and say, hey, look, SBA is requiring us to put up our house as collateral, and we're taking money out of the kids' college funds. And is that all right? And that's a tough conversation. And, frankly, an ESOP can kind of bridge the gap there. And often business owners say, well, if I sell it to my management, will I have to be the bank? And that's very often the case. You're doing the financing because the bank's not going to lend all of what's needed for a sale. There's going to be a gap, and that means the seller is often that gap. Big concern is what happens to my employees and my family if I sell to an outside buyer. And that's a real concern. You have different motives for buyers. I mentioned private equity. I'm not picking on people. Sometimes you get the absolute top dollar in private equity when they're throwing around a whole lot of money. But we have to often consider what's the fate of my employees? What happens in 5 years? What happens the day after the sale? Is the C-suite there? Or is the buyer going to take a patent and build that widget in overseas, and lay off my folks? So that's a concern. And if that is a concern, really need to explore the different type of options. And what about my legacy? Not to brag, but I kind of built this town. I'm at least a substantial pillar in this town. I provided jobs and buy cars in this town, and my family names on the library and the Boy Scout and Girl Scout uniforms and stuff like that. What happens when we sell to an outside buyer? Do those things go away or don't they? And sometimes you can ask for assurances, from whoever's buying you. Maybe they have the same goals and objectives, but sometimes they don't. And so I hear these a lot. John, do you agree?
Yeah, it's, as you articulated very well, it's not just about who's going to write the biggest check. Most of our clients, there's a lot more to it than that, as you've laid out here. And these other things can be actually more important than the size of the check. This is their baby. In some cases, more so than their actual kids, because of the amount of time they spend in the business and the amount of sacrifices they've made through the years.
Yeah, totally agree. But there are also sometimes when we say, take the check, right? It all depends on facts and circumstances.
Yes.
Okay. Now, there are some major tax advantages. And the reason I start with the bipartisan support is because people say, when we talk about these tax advantages, they say, boy, the government needs money. When are they going to close these loopholes? Because these sound too good to be true. I hear that a lot. Here are just the major tax advantages, and there's significant other ones as well. But let's just stick to the main ones here. The first one's the old school, what you read about when ESOPs were kind of coming around in their heyday as they were codified in 1974. The first benefit's for C corporations only. And there's another benefit for an S corp, which we're going to talk about next. And there's actually pending legislation in the federal, in Congress now to say, let's merge these. Why are we making people choose to be an S corp or a C corp? Because most people tend to be S corps these days. And so to get the C corp benefit, you got to convert. And there's some problems with that too. So let's just keep them separate for now, and then I'll tell you how maybe we can merge them together. If an owner of a C corporation sells their stock to an ESOP of that C corporation, an ESOP's a retirement plan. Remember, it's just like a 401k. So you have another retirement plan called an ESOP, whereas the 401k has like mutual funds to choose from, things of that sort. The ESOP has one investment, and that's the stock of the seller. That's the corporate, the sponsoring company's stock. It's just a different retirement plan that has a different investment, which is the company. So if the seller sells to their own ESOP of a C corp, the seller can defer and eventually eliminate the capital gains taxes that are normally due on a sale of a business. Pretty substantial, right? I mean, it's comparable to a 1031 real estate exchange, if anybody's ever done that. You have an old piece of land, you sell that old piece of land, you buy a new piece of land. You do not have to pay capital gains tax on that sale of the original land. Your tax basis becomes the tax basis of the new land you just purchased. And so that's similar to how this works. But in an ESOP world, and it also life insurance, 1035, an old policy, you sell it and buy a new policy. You don't have to recognize a gain, and your base tax basis transfers to the new policy, the new piece of land. And in this scenario, if you take your sale proceeds of selling your C corp and you buy other stocks and bonds of other US companies, you can defer that capital gains tax, and then through the methods that are popular in the industry, eventually eliminate the capital gains taxes that are normally due. Pretty nice benefit, one of the older benefits.
And Dan, when it comes to our clientele, the vast majority of them have almost a zero cost basis. They started this business themselves or inherited it from a family member where they had a step up in basis of some sort. So that savings is quite significant.
It is. And, currently with the rate of 20% federally, a lot of people are saying, it's not that bad, and when I'm talking about this S corp benefit, people are kind of saying, I'm going to just eat the 20% because it's probably never going to be lower. But you can tell how sensitive this will be. President Biden said he wanted to more than double the capital gains taxes. But let's get to number 2 first. This is pretty amazing too. To the extent a company is ESOP owned And most companies go 100% from the get-go. You don't have to, but when you cash flow it out, it works. But so if you're 100% ESOP owned S corporation, the profits cease to be taxable on a federal or state level. Literally, the profits aren't taxed anymore. And it's a simple tax function. Frankly, it's not even rocket science. Right now, if you're an owner of an S corp, you get a K-1. The taxable income of the company goes to the owners of the company proportionate to their ownership, and they're responsible for paying tax on their percent of the profits. And that owner files a 1040, and you generally take money out of the company to pay your tax, right? That's just how it works. That you take a distribution. And because you have a K-1, you're responsible for paying tax as you file it on your 1040. Now, what if a retirement plan, such as an ESOP, owned the stock? Who gets the K-1? The ESOP gets the tax form. The ESOP, being a qualified plan, doesn't pay federal or state income tax, just like your 401k does not pay income tax on the growth. And so therefore, since the sole owner of 100% owned ESOP doesn't pay tax, the seller, who's still president, chair of the board, and CEO, says, hey, we no longer need to declare distributions, do we? Because our one and only shareholder doesn't pay tax. So whatever you're paying right now in federal and state income tax stays at the company. It doesn't leave anymore. And what we do with that money is we redirect it to pay off the debt we incurred to buy 100% of the stock. So what would have been government dollars is now being redirected to pay you for your company. It's pretty amazing. And so that's a pretty significant benefit. And that's typically what most ESOPs in today's environment are doing. So you can see the rub though, right? If you say, I'm an S, but I really don't want to pay capital gains tax, well, we can switch. We can go to a C. Your CPA might be going, oh, no, don't do that. But if provided it makes tax sense, we could go to a C Corp. And then you say, well, great, I'll just take the S election again. That's the rub. If you're an S Corp right now, single entity S Corp or an LLC taxed as an S, and you convert to a C Corp, you're stuck there for 5 years. So yes, you could potentially don't have to pay capital gains tax, and we don't know where that's going to go. Like I said, President Biden said he wanted to more than double. I think most people, and that's another seminar, John, it's another webinar, you get somebody predict where tax rates are going to be. But I'm guessing, and from the people I know, think capital gains will probably slide in around 25 to 28%. I think we're all guessing. So then it's just a question of, well, do I switch to a C to not pay 25 to 28% in capital gains and wait out the 5 years? Or do I eat the 25% like people are doing now? They're eating the 20% because it's relatively low and be tax-free from the moment I sell my stock. I don't have that 5 years paying taxes to the federal and state government when I didn't have to. So it's kind of a rub. We have to kind of figure that out. We do the math. What's more important? And how big is your basis? And how much tax savings is going to be? And can we still cash flow paying off the debt if we're still paying C Corp taxes? So this is where some of the planning comes into play. And
If I could step in for a minute.
Yeah, please.
And most CPAs are not experts in this area. And obviously we're working with our clients' accounting firm or CPAs, but it's your firm that's running that analysis to really help us get our arms around this to figure out which is the most appropriate way to go.
Absolutely. That's exactly right. And about 20% of the time, there's some, I never want to use the word loophole. The way the tax code's written, about 20% of the time, we can get an exception that you can actually get the best of both worlds here. That's completely black letter law, no tricks, but about 20% of the time, if you're the way you're configured or things read, we can actually sometimes get you to the C Corp, not pay capital gains and not have the 5 year wait. So we always look for those exceptions when we can do it. And people are very happy when we can figure that out. And then I'm not going to get into it now, but there are some very significant estate and charitable planning opportunities in conjunction with an ESOP. So if you're very charitably inclined, which I imagine, John, I know a lot of your clients are, discussing that in conjunction with the ESOP makes a lot of sense.
Yeah, and as you mentioned before, that's another webinar in itself. We do a lot of multi-generational planning. Actually, at the present time, we have 4 families where we have 4 generations that are alive that we're working the wealth down, trying to protect it at the same time. And an ESOP can be very helpful in leveraging those strategies.
Exactly. And I'll point out briefly when we get there, what's a couple of those opportunities. You know what? I covered this at pretty good length. You're welcome to have this presentation that explains kind of the tax issues behind the scenes. You know, I kind of verbally talked about it. I'm not going to read bullet points, but I think we got that and we're going to move on here. Now, as far as the ESOP basic structure, I used to think it was federal law that I had to do a big old diagram with a ton of boxes and a ton of arrows to explain how an ESOP works. But I searched the code, it's not in there. I think people make it too darn difficult conceptually. Now, there are some devils in the details. There's always is. But track with me here. Let's assume the bank's going to lend all of it, which they don't, but let's assume the bank's going to lend everything. The ESOP, the new qualified plan, the new retirement plan you have now at your company, it borrows money from a bank. So now the ESOP has money. It uses that money to buy your stock. Now the company uses all that tax savings we just talked about to contribute to your retirement plan, the ESOP. The ESOP uses that money and pays off the debt until the debt's repaid. So the ESOP borrows money, buys your stock. The company uses all that tax savings to contribute to the ESOP as a contribution. The ESOP uses that to pay off the debt until it's gone.
Dan, a question just came in on, and I know it's specific to a particular client, but in general, what's the range of time to pay off that debt?
Well, yeah, I'll just skip it later because it's a good time to talk about that since we're talking about the bank will lend generally 40% of the value, maybe 50% of the value, depending on the size. And then it's always pretty much always a 5-year term loan at the bank. And then usually the seller will take some installment payments based on cash flow, see how much you can afford for 5 years, 6 years, 7 years, 8 years, whatever cash flow affords us. And so usually that the national average of paying off that 5-year term loan is 3.5 years. You have all this tax savings, it pays it off very quickly. And then at that point, a savvy banker would say to the seller, hey, can I refinance that seller installment notes you have? And then often in 3.5, 4 years, the seller gets the balance that was refinanced by the bank in like 4 years or 5 years. We see that fairly frequently, unless, well, I won't go unless yet. I'll talk about that later. I hope that answered the question.
And many clients will say, how can it happen so quickly? And it's real simple. We've reduced or eliminated one of our partners, and that's Uncle Sam. So
that's right.
If we can minimize that, everyone wins in the deal.
That's right. And the funny thing is, the government's happy about it. they like it because studies have shown, I don't want to digress, we have to move on. But I think a crossover is like 8 years, the governments actually net more money from the economic activity of an ESOP structured this way, higher wages, sales taxes, people keeping their jobs because they keep their jobs a lot more in an ESOP as opposed to being laid off and being a burden on the social structure. So they actually net more money from the economic activity of an ESOP than they lose by having a company not pay income tax. It's pretty wild. So nobody minds it. The government likes this. So they're not planning on shutting down these loopholes. In fact, they're looking to expand them and give more incentives. They love it. Now, as far as the employees go, the shares that the ESOP buys, they're going to eventually be allocated at no cost to the employees. It's not all done day one. It's done over a 20, 30, 40-year period because we want to have a long-term employee benefit. We put on our employee benefits hat and say how much is too little of a benefit every year, how much is too much of a benefit every year. Let's look at our 401k and our bonus programs and see where we stand and all of that. And we help you work through that. And then when the employee leaves, whenever they retire, die, become disabled, the company has to make a market for that stock and they cash out. The employees cash out at that time, their vested balance. And that's called the repurchase liability. That's something the company has to be mindful of. So when we're thinking of that, all that tax savings, we're paying off the debt. I also scream from the mountaintops, the company really should be preparing for that eventual obligation to buy the shares back from exiting employees. And the best practice is to use some of that tax savings. And I had John and his associates are like some of the best in the country at managing this repurchase liability. In fact, when we install an ESOP, we do a 20-year liability study. And then John has some methods and some ways of doing things. Believe it or not, there's insurance products to solve this that are designed specifically for liabilities like this. There's, you can use mutual funds, other type of investments. Frankly, I don't do any of that stuff. I don't care if you put in a tin can in the backyard. You really should prepare for this liability. And sometimes people ignore it until it smacks you in the face 20 years from now. So anyway, off my high horse, John knows how to wrap around that study we do and get you in a good, comfortable place that the money's there when you need it. And it's a corporate asset on your corporate books and on your balance sheet. So enough said on that for now. John, unless you wanted to comment.
All good.
Okay. I get the big questions. Okay, Dan, how much do I get for my business? And do I lose control if I sell more than 51%? The fact is employees only have a beneficial interest in the ESOP. They do not actually own stock. So they do not have what we call minority shareholder rights. If I owned one share of your company, there's certain information you'd have to give me to make sure I'm not getting hosed, right? But the employees don't have an actual statutory minority interest. They only have a beneficial interest in the trust on their behalf. So they do not have a right to call it a shareholder meeting. They don't have payroll information. They don't get confidential lists. They don't know what you're making. So they don't have that. But there is a trustee, though. There is somebody that's overseeing the ESOP, almost on behalf of the employees to report to the Department of Labor, just to say to the Department of Labor, look, I checked in on them. They're following all the rules. They're not discriminating. They're running their plan the way they said they're going to run the plan. And they say, we're all good. Everything's kosher. So we're fine. So the trustee will see some of these things, but they do not and cannot share that information with the employees.
And Dan, that's so relevant that beneficial interest might not sound like a big deal, but it is. Our closely held business owners, those who have not listened to us and said, hey, I've got some key employees. She's amazing. I need to make her an owner in the business. They will come back to regret that because it can create so many headaches and expenses for the firm versus the beneficial interest where that key employee still feels the ownership without having to share all that information, causing headaches. And also if they are a minority shareholder, they've taken on personal liability.
Yeah.
And if I'm representing them as a fiduciary, I'm going to suggest you don't want to be in that position. Beneficial interest is much more valuable to you.
Dead on. And they're not getting a K1 every year. And they don't have to come up with money. You don't have to do
dreaded K1.
You don't have to come up with money to pay taxes either. And so the board continues to control the company as they always do. And guess who that is? Selling shareholder, family, key management, whoever you want it to be, remains in control of the board, still runs the company, even if 51% or more is sold to the ESOP. Pretty cool. That's one of the first questions I get. Are my employees going to vote me out tomorrow? And the answer is no, you still control the business. And that's one of the biggest myths of ESOPs too. So if anybody says to you, well, you don't want to lose control of the company, say, I heard Dan say, I do not lose control of my company, and send them my way and we'll have a talking with them. And then the current board being you pass the reins on to your desired successor, kid, management, nephew, whatever, to whoever you want to, whenever you want to. So you can stick around, get salary, perks, benefits, healthcare, phones, cars, clubs. You can still get all those kind of things as long as they're kind of reasonable because you sold the company. We kind of kid and say you lose your thieving rights. Now you have a contract, you're an employee, and many times we have to raise your salary because you weren't taking that much out. And so often we have to raise your salary to market level as opposed to the opposite. And the sellers and the buyers negotiate with the trustee for the sales price. So what price do I get? You get a negotiated price. It's a true arm's length negotiation to determine sale price. Now people say, well, I get a lot more from private equity. If they're throwing around stupid money, yeah, maybe. ESOP's a financial buyer, just as I would be a financial buyer if I came into your widget factory and says, hey, I want to own a business. Here's fair market value, revenue ruling 5960, willing seller, willing buyer, all known facts on the table. That's what we're doing. And that's the value you get in an ESOP. How do we finance it? Now, this is the kind of, there's two big sizzles here in the ESOP. One is not paying tax, which kind of pays for everything. And the second is, how do we design financing around that? Because as I mentioned, the bank's not going to lend 100%. So what do? That leaves a kind of a gap. Well, the industry's kind of figured out a way to make lemonade out of that lemon. So it's usually a combination, as I touched on earlier. We'll take what the bank gives us, and then the seller generally takes installment notes. You'll get some payment. You're not lending the company money, but you'll just get, instead of getting your money up front, you might be getting $1 million a year for so many years or something like that, whatever cash flow allows until you're paid off. So it's usually a combination. But with that, we could go, I don't think I missed a slide, did I hear? No, I didn't. With that, we could actually go find somebody that says, hey, I'll lend you what the bank doesn't. I'll be subordinate to the bank. I'll be interest only until the bank's paid off. Well, you better bet I'm not taking 4%. You know, I want 8 to 9% or 6 to 8% or 10%, whatever the current rates will be, to sit in that position. So we say, don't do that. Don't do that, because the bank doesn't like it. The trustee doesn't like it because it hurts the growth of the company. And frankly, that high, even if you took that, well, yeah, it just hurts the company overall. So we say, let's do it a different way. Instead of paying somebody else that total return, why don't you take it? Why don't you take it? So the sellers deserve that total rate of return. So then the question becomes, well, there's many different ways to get that total return. The obvious one is, well, just give me the 8 to 10% interest, or 6 to 8, whatever the interest is, right? That's the simple way. But for the same reasons, the bank says it's harder to pay off their note when you're paying that interest. The trustee says that's hurting the value of the stock for the benefit of the employees. And frankly, from your standpoint, interest on a note is always taxable as ordinary income. So you're losing a huge chunk of that to ordinary income tax. We say there's another way to structure this to replace what you're giving up, but maybe even make it even better. And so what we typically do is we say, seller, you bear those seller notes. You get those payments over time, but we're really going to reward you for doing that, because you're replacing somebody that was going to take 8% or so, and you're going to be interest only, sitting behind the bank. But really, what's the difference in risk? You hold on to your equity, or you're still president, chair of the board, and the CEO of a company that owes yourself money. I mean, really, how different is the risk itself? But from a lending standpoint, the IRS agrees, Department of Labor agrees, the courts all agree, you deserve to be rewarded for that position. And here's how we do it. We say to you, once you get 100% of your purchase price of the principal, you got what you got from the bank up front, you got your seller note payments at 4, maybe we match the bank, say 4% instead of the 8 or 10, you have 100% of the sale price, but you did leave a little something on the table, didn't you? So how we make that up to you, and it's usually a lot bigger than that, when you're 100% paid out, we give you an additional payment of up to 20 to 25% of whatever the future value of the company is at the time that debt was paid off. You get another bite of the apple of the total value of the company, up to 20 to 25% of whatever the then value of the company is once all the other debt's paid off. So if we had a $10 million company, just to say there, and it doesn't grow at all, let's say it doesn't grow, it just stays stagnant, and just $10 million. Once you got your $10 million, maybe 4 from the bank, 6 in installment notes, you had some interest on that. Once you get your full 10 million, get another $2 to $2.5 million on top of that to reward you for bearing that seller debt. That's how we're getting you that total return. But in reality, what's really happening here is this $10 million company, and maybe after 8 years or something, when all the debt's paid off, this $10 million company is really $15 million. So now we're getting another $3.5 million or something like that, as opposed to 2 to 2.5 million. And that's taxable as capital gains, not ordinary income, as that interest would have been.
And what's also magical about that, Dan, is you know, is it keeps everyone who's involved in this in alignment.
Mm-hmm.
Everyone's working in the same direction because it's in everyone's best interest.
That's right. That's right. And frankly, I understand. I work for somebody else. Well, it's a long story, but I get that this is your baby. And John, you mentioned that you started with Joe's cement company with a bag of Quikrete in the Worldboro, right? So you grew this thing. Sometimes it's hard to just sell it outright and either walk away or worry about it. Well, you're still getting 100%. Plus, you still have an equity stake going forward, and you're still an employee for as long as you want to. It's really a nice way to walk away, but not walk away. In fact, we recommend you do stick around until those seller note payments are substantially paid. You don't want to hand the reins to the key manager and never look back in on the company until you're paid off completely. And sometimes you make a deal with your management. Look, faster you pay me off, the faster I promise to walk away. And now you'll become president, CEO, and chair of the board. Boy, that's a heck of an incentive when old man's out, right? And I get to run the show. Let's pay him out fast. I hear that. I kind of hear that a lot. Here's just an example of a total outcome on a $20 million company. So this is a client of ours. We're around 20, I rounded it, but we got 40% from the bank. So the seller got $8 million up front, got another seller note principal payments of another $12 million. This happened to be over a 15-year period, and that was by their desire because they were getting a future equity stake and they weren't going anywhere. They said, I want this tax-free company to grow and bake for as long as I can. I want this to grow for 15 years. So when I cash that in, I forget what this grew to, but my $20 million company is now a $35 million company or whatever the case may be. That was their choice. It doesn't have to be that long. So we had $8 million up front, the $12 million of the principal payments on the seller note, plus we had a reduced interest rate than they actually deserved on the seller note. They got, in this case, it was 4.5% interest, got another $4.5 million. They got the reward that the future equity stake for bearing that seller note at 20%, and it grew after a while, another $6 million. And so when you add it all up, it was about $31 million they got for a $20 million company, and the $8 million may or may not be taxed as capital gains. The $12 million may or may not be taxed as capital gains. I mean 0% tax or capital gains tax. Because remember, if we can figure out that exception, or you're currently a C corp, that 8 and that 12 will be tax free. Worst case, you have to pay capital gains under current law. That's taxable at 20%. The seller note is the worst taxation here because that's taxable as ordinary income. That's $6 million for some way magically, and some accountant can explain it to me again, that when you get that second bite of the apple, it changes it from ordinary income tax, as the interest would have been, to a capital gain tax, not ordinary income tax. And so owners seem to be very pleased with this. This structure being tax-free and doing seller notes with getting a second bite of the apple later, it accounts for probably 75 to 80% of all ESOPs being put in place across the country.
Your example here really drives home the point that dreaded private equity firm, which in some cases, I say that sarcastically, might be the right answer. But even if they can write a check that's substantially larger, it doesn't always mean that the owner is going to end up with more dollars because of the tax benefits associated with this.
Yeah. This just takes a little longer. That people say, what are the downsides? I wanted to walk away tomorrow. Well, an ESOP's probably not the best fit for that. Yet you want, like I said, you want to stay on board and make sure you're substantially paid out before you walk away. So it does take a little longer. But when we compare market multiples to maybe what some crazy money might come in at, if you're willing to wait a little bit, even if we adjust it for the time value of money, we'll take this 30 million multiple on this company, even if we present value compared to the present value multiple of whatever private equity or somebody's given you. I'm usually very happy with what ours ends up being. It just takes a little longer getting
there. Yeah, and you mentioned that it does take longer, and it certainly does. But our experience over the last 30 years is most clients, as much as they say it's about time to exit, that's about a 10-year conversation that we're having with them before they actually do it. Even though they say they're ready, they're really not ready. Yeah. There are those situations where someone has some type of life event where it's like it needs to happen now and they're out. But that truly is an exception, not the normal.
Yeah, I agree with you. One of my associates who's bought and sold several businesses, he goes, I failed at retirement. I can't stop.
I like that.
Yeah. Okay, here are the objections I often get. ESOPs are too complicated. Now, I did simplify it here. And yes, believe it or not, I did. But ESOPs are complicated. The devil is in the details, but so are many worthwhile techniques. I bet some of the tax strategies and financial vehicles that John's talked to you about are complex. But when you have the right people that you know, trust, and you get all your people on board, your accountant, your CPA, your financial advisor, and you bring an ESOP specialist like somebody like me or my peers, we get you through it, make it, help you make decisions. And next thing you know, you're through the process. We hear ESOPs are expensive. Well, I say they're priceless, but the true answer is it's relative, right? What is the cost? We're selling a business here. It's not like we're putting in I don't know, dental plan. We're selling a business here. And so ESOP costs are expensive. It can be, but it's relative. Consider the cost of a business broker, private equity, legal fees. Typically, ESOPs are half to 3/4 of the fees of the other type of sales, frankly. So yes, it may be a very large consulting check you're writing to a lot of attorneys and to consultants, but compared to other outright sales, it can be very cost effective. Plus, hey, you might not be paying capital gains tax. You might not be paying tax on profits anymore. And I know that's no excuse. And we're not just jacking prices up because of those, but they are complicated, to go back to number one. And there's a lot of people that need to be involved. You have a trustee, they have their own attorney, they have their own valuation firm. We have an ERISA ESOP lawyer, we have consultants, we have seller side valuation, we have third-party administrators. And so these people are introduced when they're needed, but they cost money. And so it's all relative. And we addressed this one. ESOPs are going to run my company. No, it's not true. We talked about that. Financing. It's not hard. It's really not hard to finance an ESOP. Banks are willing to do it.
One point on the banks, we really try to drive home to our closely held business owners that many of them are quite conservative and try to cash flow everything themselves, but really drive home the point of you need to have a true relationship with a banker, so that when it comes time, if this is a strategy that we're putting in place, that they're really comfortable with you, understand your business, are willing to work with you, rather than knocking on a door of a bank and saying, we want to do an ESOP, and you're a stranger to that bank.
Yeah, right. And there's some ESOP specialist banks out there. In fact, John, you're in the Chicago area. There's some really top-notch banks out there that just get ESOPs, and they're willing to do it. So I'd be happy to introduce anybody to those folks when needed. Well, okay, here's our process and steps for the sake of time here. This was an ESOP 101, an abbreviated version, believe it or not. Be happy to do as many as you're welcome to this presentation. I have more detailed versions. I have white papers. I have articles. I got all kinds of stuff. Be happy. You'll find people in my industry, ESOP world. We love preaching the gospel because there's not a ton of people out there preaching the gospel, right? We're not hearing business brokers and the big M&A attorneys talking about ESOPs because, frankly, they don't make as much money. Sometimes it's easier just to sell a business, get in and out, and take a big fee. ESOPs take a little more time. And you have the government to worry about, and it's not their expertise. So we're happy to educate as much as you want. We're happy to do this again on a personal basis. We'll get together on a Zoom, or when I come to Chicago. My kid goes to school in Illinois Institute of Technology, so he's downtown. Love to come see him. But we're happy to do this with you and go over it again, answer personal questions, because I know probably not throwing out a whole lot of personal questions here. That's the first thing. That's complimentary, compliments of private wealth management. We have a kind of a national agreement with some of the affiliations of John and John's firm, especially. We do several of these complimentary things at no cost to his clients, just as a service he wanted to provide to you. So I appreciate you doing that for your clients, John, and thanks for choosing us to provide these based on our special relation. We don't do that for everybody. The second thing we'll do is, if you like the ESOP 101, even from here, you said, I heard enough. I wouldn't mind an ESOP, a written ESOP financial review. No, I'll sign Dan, we sign an NDA? Of course I will. I'm happy to look through all your information and give you a kind of a written summary of where I think the pros and the cons are for you. Do you look like you could do an ESOP, or should you wait a year? Or, hey, your payroll's not big enough, or your existing debt, let's pound that down before you sell your company. You get more, that kind of stuff. Happy to go through some compliance testing behind the scenes. I'll give you kind of a written report on what we see. That's before you spend the nickel. And then
before you go
please.
on, Dan, that financial review is really relevant, because in many cases, as Dan sort of alluded to, hey, there's some things that you need to work on, and we work on those things. And then over a period of time, when and if we're ready to pull the trigger on an ESOP, we've got it pretty much all lined up where we need to be to have it do what it needs to do for us.
That's right. That's exactly right. And then at that point, you've had a couple checkpoints already. You know, you kind of like the idea, don't like the idea. Well, if you do like the idea enough to take a baby step, we do something called a preliminary valuation / preliminary analysis. And we charge about, for John's clients, about $7,500 to give you a valuation you can hang your hat on. And then and that's by a real live person, by the way. That's not thrown in some computer program and it spits out, here's what the value should be. We have a valuation team of 4 people that collaborate. We look at 3 or 4 different methods of valuation. We blend them. We look at market comparables. We have a discussion, get input from you based on, hey, why is your AR so long? Or, you know, all these different things. And who's your competitors out there? Who should we use in our market comparables to you? Because you have a unique industry. Kind of look at all of that stuff and give you a valuation range you can hang your hat on. And then once we think that's fair and you think it's fair, you agree with our methods, then we'll run a couple cash flow models in a preliminary analysis to see if it cash flows for you. And we do that little baby step because if you can't get the value right and you can't cash flow it, why are you doing anything else? Stop, right? So we stop there for $7,500, roughly, sometimes 10. We give you kind of that thing. If you don't like it at that point, you have a valuation you can hang your hat on, you walk away and you're a little smarter and you have a valuation you can use for other purposes. But if that stage looks really good, then we can move on to a full feasibility study. And this is where a lot of people start in my industry. They don't do that upfront, but and a lot of people choose, even though we offer that number 3, a lot of people choose to go right to a feasibility study. I know I can cash flow it. I know what this is about. Let's save $7,500. Let's just go right to a feasibility study that costs $25,000 to $30,000. That's the blueprint for implementation. You need to do a feasibility study. It's looking at bylaws, recommending stock splits. We're talking to banks. We're figuring out exactly what that future equity stake is going to look like. We're figuring out your exact taxation, what your tax basis is, and making those recommendations specifically to your situation. Should I switch to a C? Should I not switch to a C? That kind of thing, and making definitive numbers there, as opposed to the previous ones, kind of higher level, that we think you can get this capital gains tax deferral. Here's what it looks like if we model it. This is the detail. This is the blueprint, 25 to 30 grand. Then at that point, if you say, yes, let's do it, let's go, then we implement. That's when we hire all those other people we talked about, the trustee, their counsel, their valuation firm, the TPA firm, the ERISA firm, the other consultant. We hire the different people in us, the people you need to pull the trigger. And that's where the larger expense comes in at that point. But that's after you've had 4 checkpoints. So by the time you get to that point, you're pretty darn sure that's what you want to do. So it's not like you heard this today. Do you want to do an ESOP? Yes or no? A lot of checkpoints, a lot of analysis along the way. So you feel pretty darn sure you're doing the exact right thing, and you've talked to all your other consultants and everybody agrees. And so that's our process. And I'll stop. I'm a little over there, Cheryl. Don't yell at me.
Cheryl, do we have time for a few questions?
Yes, we do.
Okay. Dan, you've mentioned, your other retirement program, your 401k, your profit sharing program, et cetera. Talk to us about how the 401k profit sharing program works in concert with the ESOP.
That's a very good question, whoever asked that. Yeah, generally we recommend that the 401k absolutely stay in place. There's a practical reason and also just a perception reason for your firm, right? You don't want to be perceived as taking something away. Now, sometimes people, because the ESOP contribution is so large, it could be up to 20%, 25% of payroll. It's pretty large. So sometimes people forego the match. It's just an individual company choice. We're not going to do the match. Maybe we'll keep the match because we want to say we didn't eliminate anything. But you almost always keep the 401k. It's highly recommended. But they do need to be cross-tested because there's contribution limits into all qualified plans. So you need a qualified third-party administrator that understands both 401ks and ESOPs, and we recommend those people to you.
Great. We actually have several more questions, but I think I'm going to cut it off here with just one more, and it's kind of 2 different items, but they come together. when it comes to the ESOP, you've been talking about family businesses for the most part. What about when it's not a family business? And then also, do you have any control over how much you give to particular individuals? That can you discriminate to any extent?
Yeah. Well, I'm going to start with the latter and then work my way to the former, if you don't mind. Technically, this is an ESOP. It's a qualified retirement plan that you cannot discriminate. So once you have to follow the rules, but that doesn't mean you can't set up the rules on the front end in the plan document to do certain things the way you might want to do it within limits. So if you want to reward people that have been there a long time, we can write the plan that way, but maybe they get a few more shares. But typically, it's got to be non-discriminatory. But we can add a plan that's layered on top of the ESOP. That's not part of the ESOP. We do maybe some kind of synthetic equity where we give our managers phantom stock or stock appreciation rights. So we're tracking 200 shares for my top employee. Doesn't actually have them. We just have a legal binding contract that says I'm tracking 200 shares of Joe, my key manager here. And when Joe retires, he gets the value of those 200 shares. And it's a legal binding contract. It's up and above the ESOP. We often do that for key folks that you need to drive the value of the business. Now, as far as family goes, I hear a lot. People say it's one of the myths. We're a family business. We shouldn't do an ESOP. No, we do a lot of ESOPs in family business because it often comes to a point where, look, I want my kid to run it. I'd like my family name on it. I can't afford to just give the business to my kid. And they can't afford to actually buy it either. And so I'm kind of at a rub. What do I do? If I sell it to somebody else, my kid's probably fired because not all that bright. I'm kidding. But, you don't know the future of the family, but you want it to still be in the family name. You want grandpa, the founder's picture in the foyer. You want to, continue to pay that receptionist is being way overpaid what you're paying her or him. You want to continue giving to the Boy Scouts and the Girl Scouts, things of that sort. So a lot of folks look at it as we're expanding the definition of family. I might be generation 5. I want to cash out for the benefit of me and my family, and I want to get rid of my cousins that are kids of my uncle that have nothing to do with the business. I'd like to clean all that up, consolidate, sell it to an ESOP, have my family run the business. I name my own kid president, CEO, and chair of the board when I'm ready to do that. And all those things still happen. Grandpa's bust is there, and the kid gets the big salary, didn't have to come up with a payment on his own. And it's still that community and family legacy name on the door and foyer. It just by this one generation cashing some money out and kind of expanding that definition of family versus that generation needing money and selling it to somebody else. That's the worst case scenario. This kind of is like a bridge in between. And we do that very often, and people have in their head, this doesn't work in a family situation. It works very well in a family. So it saves the legacy. So I'll end with that, John.
Yeah, I'm glad you mentioned that because it does create the opportunity to do a lot of cleanup that sometimes family businesses get a bit sloppy. And this is our opportunity to pull it all together, but take care of everyone and move on for the continued success of the business. Cheryl, do you want to jump in? Do we have any other questions, any more time, or are you going to shut Dan and I down?
Yeah, no, you do have a couple more minutes, and we do have a couple of questions from the audience. The first is, do you happen to know what the going term rates are from the term loan from the bank? Are there any drivers on structure, interest rate, variable versus fixed?
Yeah, most are going fixed right now, and it's the low. I mean, we're talking 3.5% to 4.5% right now. It's a company's guaranteeing it, so it's really just a commercial loan to the bank.
Okay.
From the bank, yeah. So it's not anything too special, believe it or not.
Okay.
And one of the reasons why the rate is so reasonable is because the bank is using the collateral of the company to back up the loan.
Yeah. Yep.
Okay.
And lending to a tax-free company, by the way, right?
Okay.
Banker, who do I want to lend to? A company not paying tax or a company paying tax, all things being equal. And if a bank is smart, they get 3 loans. They get the original loan, 5-year term, they refinance the seller notes. And then when you get that future equity stake as the reward for bearing the seller debt, they refinance that too. So a smart banker gets 3 loans there.
Okay. Another question we have from the group is, if you've recently gone through an ownership transition, what's the timeline to wait until moving toward an ESOP? Is that once the debt is incurred to purchase the shares are paid back? In this particular case, the person asking the question says the company was recently purchased as an S Corp to an S Corp purchase using a 331 H10 structure.
Wow, Cheryl, that's impressive.
I
Wow.
know, it's not my forte. This is you
Cheryl,
guys.
can you please explain to the audience what that means? Of course, we all know, but can you please explain that to everybody?
No. That's why we have
Well-
experts like you.
Well, I think one of the biggest concerns, and I think you mentioned that, is the fact that there's still debt on the books. So, just like, a house with a mortgage, you only get the equity value, so if there's debt on the books, you probably might not be getting a whole lot of equity out of the company, because somebody comes in, even an ESOP comes in and buys it at full fair market value, which they will. First thing you got to do is pay off the existing debt. And so then the people holding the equity will get that whatever equity's there. So many times people do want to pay off that debt, so you get the equity higher. That's the first thought. But as far as like rules or anything, you can look at, ESOPs are ready, willing buyer. I'll buy stock from anybody, that has stock of a company. So there's no time rule or anything like that.
Okay, awesome. Gentlemen, we are pretty much at the top of the hour. Are there any closing remarks by either of you?
Hey,
We
just
are, go ahead,
I
Dave.
appreciated being and talking to the wonderful folks, and those great questions, by the way.
So Dan, we appreciate your time and your wisdom, and for all the attendees, thank you for sharing your morning with us, and have a great rest of Thursday. And please call with any questions. We're here to serve, and have a safe and happy holidays.
Awesome. Thank you, gentlemen.
Thank you,
See you at
Carol.
the
Great
next
day.
one.
Okay.